Hey, what's up YouTube? In this video, I'm going to tell you how a 401k really works. Well, technically, I'm going to share with you about how all qualified plans work. So if you have a 401k, 403b, 457, or any other qualified plan, you're going to want to watch this video because I'm going to tell you exactly how they work from start to finish. My name is Paris Clough, and this is Financial Self-Reliance. On this channel, we teach you the mindsets and the skill sets of the wealthy so that you can learn how to manage, protect, and grow your assets. If that sounds like the kind of community and channel you'd like to be a part of, go ahead and click like and subscribe so you don't miss any of the videos that I produce. All right, so let's first talk about taxes. One of the main reasons why people want to put money into a 401k or 403b or other qualified plan is because of the tax advantages. So I think it's important for us to talk a little bit about how taxes really work so that you can see how 401ks and other qualified plans really work as well. They're all different pieces to the same puzzle, so it's important to get to know each piece so that when you put them all together, you got the picture you want. So first, we're going to talk a little bit about how federal and state taxes actually work. Then I'm going to share with you a presentation that I made many years ago to explain how 401ks and qualified plans work, and I promise it's going to be in plain English. I've given this presentation to hundreds of people. Some of them have worked for the IRS, and several of them were distinguished CPAs. And they all agreed that this is one of the best and most simple explanations that they've ever heard about the concept of how 401ks really work from start to finish. See, a lot of people will put money into a 401k and then they don't ever think about what will happen as they go to take that money out. It's important to know the whole picture, beginning, middle, and end. And my presentation is going to break it down in plain English. So I'll be honest with you, taxes aren't easy to understand. I don't know if you've ever seen the tax code, but the darn thing is 10 feet tall. So I'm going to make sure to do my best to make sure that you understand how tax brackets actually work, because it's actually critical to how much money you put into a 401k. So across the top you can see single, head of household, married filing jointly or qualified widow, and then married filing separately. The tax rate over here on the left column is the amount of tax that you'll be charged on the amount of income that you make. If you're single, from $0 up to $9,875, you're charged a 10% tax rate. Married filing jointly is 0 to $19,750. So the second row is 12%. From $9,875 to $40,125, you'll pay 12% of that income as taxes. On the third row, if you're single, any money that you make from $40,125 to $85,525 is going to get taxed at the 22% rate. And if you're married filing jointly, anything between $80,250 and $171,050, you're going to be charged 22%. If you're married filing jointly, you'll have 10% on the first $19,000, 12% on the next $60,000, and then 22% on the next $90-ish thousand, give or take. And if you're married filing jointly, you'll pay 24% between $171,550 and $326,600. You'll pay 32% on anything from $326,600 to $414,700. I think you get the picture. A lot of people think that if they earn $100,000 a year, they're going to get charged all of that amount of money at 22%. And that's not how it works. So if you're a single person making $100,000 a year, you're not going to pay 24% on all of that money. You're only going to pay 24% on the money above $85,000. From 40 to 85 is going to be at 22%, and from 9,000 to 40,000 is 12%, and from 0 to 9,000 is 10%. So a lot of times people think, well, I'm making $100,000 a year, I'm going to be taxed 24%, I'm going to have to put all that money aside, that's $24,000 that I'm going to have to pay in taxes, when in reality that's not the amount of money that you're going to pay in taxes at all. All right, now let's look at state taxes, and where I live in California, it's a very similar situation. So in California, the first $8,544 is going to be charged one rate. The next $12,000 or so is going to be another rate. The next $11,000 is charged at another rate. So as you can see, every tier, you're only charged for the tier that you're in, and the money that you earn is only charged in the tier that money is in. As you make more money, you'll go up in the tiers, but it's only that money that crosses over that threshold that's charged that higher tax rate. If you're making $100,000 a year and you live in California, not all of that money is going to be charged at 9% or 10%. Some of that's going to be charged at the 1, 2, 4, 6, and 8% as well. So that's important to realize that when you put money into a 401k or an IRA, it's taking money off of that top tier. year. And so the money you actually put into the 401k is going to be saving you the rate of tax in the top tier of the income that you have. Let me just show you this map. It's kind of cool. It actually shows you how much each state charges for their state taxes. So as you can see in this particular map, you can see California the top tier is 13.3%. So California is a very expensive place to live. And then places like Nevada, Washington, Wyoming, South Dakota, Texas, Florida, and Alaska, you don't pay any state taxes if you live in those states. Maybe that's why those states are pretty popular. All right, just to give us a little bit better information, a little bit more resources to really kind of drive this home, I did a Google search for the average income in America. And according to Investopedia, it says that the average income or the median income for US households in 2018 was $63,179. So if that's the case, let's take a look at these charts and see where that lands us. So in California, that will land us in the 9.3% tax bracket. And now according to the federal brackets, if we earn $63,000, so now we're in the 22% tax bracket. Between $40,000 and $85,000, we are charged 22%. So our federal, if we lived in California and we were single making $63,000 a year, we would be in the 22% tax bracket federal, and we would be in the 9.3% tax bracket for our state taxes. So if we were to put any money into a qualified plan, we would reduce it from that tier. We would be saving about 33% in our taxes based on the fact that we're reducing our income by the amount of money that's in those tax brackets. I'm going to bring this all together in my presentation. I just wanted to set the stage really quickly, so I promise this is going to make sense in a minute. All right, so here's the presentation that I've shared with hundreds of people over my career as a financial services professional. This particular presentation has helped more people understand the whole process of how a 401k really works. We're going to take you through the 3 phases of a qualified plan. The first phase is the contribution phase, the second phase is the accumulation phase, and the third phase is the distribution phase. So you can see that on the screen right now. All right, one of the things to consider is that these plans are called qualified plans. Well, who in the world qualified them? If you guessed the IRS, you're exactly right. So raise your hand if you believe that the IRS created these tax advantages out of benevolence and kindness for us and with our best interests in mind. That's what I thought. So let's take a look and see if these qualified plans are really all they're cracked up to be. All right, so just to clarify, qualified plans by the IRS are 401ks, 403bs, 457s, and IRAs. Now, just as a very brief introduction, a 401k is for corporations and companies that make a profit. 403bs are for nonprofit organizations, and 457s are for governments. Now, there are other qualified plans, but most people know about these ones. So in this particular presentation, let's pretend that you're 35 years old and you're gonna accumulate money for 30 years and retire at age 65. The average person puts in about $250 a month into their 401k, so that's about $3,000 a year. So $250 times 12 is $3,000. The most important thing to remember about this presentation is that this presentation is about the concept of how these plans work. The actual numbers, the actual details will vary from person to person and from experience to experience. So let's say that you earn $63,000 a year and you took $3,000 of it and you put it into your 401k. That means your taxable income would not be $63,000, it would now be $60,000 because that $3,000 is now non-taxable because you put it into a 401k or qualified plan, thus allowing you to have a tax deduction. So this first column is the contribution column, and those contributions are all tax deductible. If you did that every year for 30 years, that's $3,000. You don't have to pay that 30% tax rate. And that's about $900 a year that you didn't have to pay in taxes. So over the course of 30 years, $900 times 30 years is $27,000. That's a lot of money to save, right? If I told you right now that if you did this plan, you would save $27,000 over the next 30 years, you would probably think that was a great deal. And that's exactly how they promote it. They promote all the benefits in this upfront column, not really getting into, or maybe kind of setting to the side, the things that are going to happen in the distribution phase. So let's say that you take that $250 a month and you invest it in the market. You earn an average rate of return of about 8%. Over 30 years, that'll get you just about $400,000. I think it's $380,000, but just for ease of math and just for the concept's sake, I'm going to use $400,000. So let's say that when you go to live off that money, you're going to take out 10%. So you have $400,000, you're going to take out 10%. That's way more money than I recommend taking out, but it's important to see the concept here because no matter what percent you take out, the concept is the same. So if you pull out 10%, that's going to give you $40,000 a year to live on. Now, I don't know about you, but $40,000 a year is not that much money. Plus, with inflation, that $40,000 is not going to go very far. So let me ask you a question. What do you think is going to happen 30 years from now? Are taxes going to go up? Are taxes going to go down? Or are taxes going to stay the same? So this chart shows you the highest marginal tax rates every year since 1913. As you can see in the 50s and 60s, the highest marginal tax rate was over 90%. Now right now it's only at 37%. But with the way the economy's going, with the way our country's going, with all the debt we have, it wouldn't surprise me if at some point we had tax rates that were that high once again. Since I don't have a crystal ball and I can't see the future, let's just pretend that taxes stay the same. Every dollar that you pull out of a 401k, 403b, or 457 or other qualified plan is completely taxable. And we're just going to say, for the sake of the concept, that 30% is the tax rate that you're going to have then as well. That means you're going to have to pay $12,000 in taxes, roughly, conceptually speaking. That's not the exact dollar amount, but it's going to, I'm just sharing with you the concept here. Well, the average person lives in retirement for 20 years. So 20 years paying $12,000 a year in taxes means that you're going to pay $240,000 in taxes. Over the last 30 years, you saved $27,000. The government was kind enough to give you a tax deduction so that you didn't have to pay $27,000, because they knew over the next 20 years, while you're in retirement, while you're pulling this money out, you're going to have to pay taxes then. They knew that at the end, they were going to get, over a 20-year span, $240,000 from you. So let's get real. To whose advantage is the 401k? The IRS made these plans available to us, told us that we need to put everything we can into these plans so that we can have all these great tax deductions, so we can accumulate all this wealth, because you know what? They knew they were going to get a significant percentage of it when you started pulling it out. It sounds to me like the IRS knew exactly what they were doing when they started promoting 401ks and other qualified plans. So is there any real benefit to a 401k? Absolutely. The silver lining, in my opinion, is the company match. Now, a lot of people will tell you the company match is extra money, it's free money. The reality is that if you put $250 into this thing and the company matched you $250, basically what ends up happening is you can double all these numbers that we had here, and the company match ends up paying your tax at the end of the day. So 30 years from now, all the money that you accumulated with that company match, that's the money that's going to go to pay your taxes. So the money you contributed, you can use free and clear. In my opinion, put into the company match and no more. There's other places you can put that money that are going to be better for you than a 401k or other qualified plan. So let's go back to our example. And if you're making $63,000 a year and you're going to contribute to a 401k and the match is at 3%, that means you're going to put in $1,800 a year and they're going to put in $1,800 a year. That's not necessarily free money. What that is that you have now got the employer paying your future taxes. That's all that really ends up being. So let's just get real about what a 401k really is, get clear on the rules of a 401k, and play the game to win. If you don't know the rules, you can't win the game. And I'm here to teach you the rules about what a 401k really is. In the example of the 401k, you get to have a tax deduction on the contribution, but then you have to pay taxes on the growth. You have to pay taxes, so to speak, on the harvest. Let me ask you a question. If you were a farmer and I gave you an opportunity to pay taxes on the seeds or to pay taxes on the harvest, which one would you rather pay your taxes on? The seed or the harvest? Put in the comments below if you'd rather pay on the seed or the harvest. Well, by putting money into a 401k or other qualified plan, you're putting money into a place that's going to tax the harvest. Now, if your company's matching, the company match is going to pay that for you, so your money gets to grow without having to worry about that. That, to me, is the only reason to put money in a 401k. Otherwise, pay taxes on the seed, let that money grow, and then when you have the harvest, you don't have to pay any taxes on that. And the three options that I know of are a Roth 401k, a Roth IRA, and investment-grade life insurance. Those are the three best places to put money where you pay taxes on the seed, let that stuff grow, and then you never have to worry about paying taxes ever again. When I retire at 65, I want to retire from having to do my taxes every year. Wouldn't you like to retire from doing your taxes every year? And so in my career, I see this all the time. People who get to the end of their career, they have this huge harvest of money in their 401k. They want to put it into a retirement account and live off of it for the rest of their lives, only to realize that they don't get to have all of it. They only get to have a portion of it because because a significant percentage is still going to be taxed. More and more people are realizing that they would rather not have taxes on the harvest. Roth IRAs and Roth 401ks are becoming more and more popular, and as more and more people are learning about it, investment grade life insurance is also going to be extremely popular in the future. I hope this video helped you understand exactly how 401ks and other qualified plans actually work. I hope you realize what the company match really does. I hope you now know from beginning to end, from contribution to accumulation to distribution, how these 401ks really work. I hope you got a lot out of this video. Please like and subscribe so you don't miss any of the future videos that I produce. I hope you have a great day, and I look forward to seeing you on the next video.